sparked the rally, saying that demand is through the roof and that the $660 billion capex build-out is sustainable. This is important because the whole reason the market was freaking out last week was because of AI fears and capex unsustainability, and not even the Mag 7 players were immune from that. We saw stocks like Microsoft and Amazon tanking last week. Now, Trump even just came out and said the Dow crossed 50K, but he predicted that it'll double to 100K by the end of his term. That is a pretty big statement from the President of the United States, and that should make bull traders very happy going into February.
But Wall Street's major players seem to disagree. We can see when we look at Goldman Sachs prime book data, it shows that hedge funds actually added the largest volume of short positions last week, making it the biggest single week of shorting on record. The last time we saw anything like this was in June 2022, when hedge funds shorted so much after the Fed hiked rates by 0.75%.
Yeah, and we can see in the shorter term, markets were volatile, but ultimately ended up rising a few months later throughout 2023 into 2024. But there was definitely some volatility in the short term. And in the shorter term, insider selling is also on the rise. There was an overwhelming amount of insider selling last week. Now, depending on what flows you look at, 97 to 100% of the significant insider trading last week were sells. It says a lot when people with the most information in the stock market are not touching it right now. And I think that that's been something that has been maybe causing a lot of the selling pressure with SPY lately. If we look at the SPY on like a 1 hour chart here, we can see that it has been very volatile. But on Friday, we did get that really good recovery and move back to the upside. Something that we've been watching for, Mike, is this broader uptrend with the SPY. The SPY has been in a broader uptrend for a long time now, as it's been continuing to push to new highs, but every time it makes a new high, it pulls back. And we saw that happen again recently. A new high was made and the SPY pulled back. But we're now holding that trend, and instead of continuing to the downside at the end of last week, we got that great bounce back. Right now, the SPY is only 1.12% away from the all-time high, which is at 698.34. If we end up getting towards that this week, watch for a potential breakout. I really like the high of day Friday, right around 692.30 to 692. That's going to be a big range that I watch for. We need to really break through that because the recovery move on Friday was very exponential and we saw a great pop out of the market. Sometimes after we see huge pops like that, there can be some consolidation or maybe 1 or 2 days of redness before the uptrend continues. But I really like going back, Mike, and looking at this broader uptrend because it really supports that there could be some buying pressure up to the new high. Like there's a lot of cases lately where SPY will come up off the dip and move for multiple days in a row.
And it's great to keep in mind that we're still only 1.12% away from all-time highs. 676 was a pretty big support level from last week. It was that low on the daily chart, and there was that after hours low as well, right around 671. I would say these are the most important support levels to keep in mind in the short term. So let's keep these close on watch. But overall, it's great to see this recovery. And we also have some fun Super Bowl stats for everyone today. We can see in the past, whenever there's been a 21-point blowout or more, the S&P 500 has done pretty well. But of course, take stats like this with a grain of salt.
Yeah, it's really fun to look at stats like this. Of course, the market does not have to move based off of how the Super Bowl performs. But hey, if you're into the Super Bowl, let us know who you think's going to win down below. If you're not into it, then hey, that's your thing. But I find these stats pretty interesting. Every year the Super Bowl comes up, we do see some pretty fun stats in this sense. Just remember that, take it with a grain of salt, like Mike said. But Mike, than that, on Wednesday, we're going to be getting jobs data. We're going to be getting the non-farm payrolls and the unemployment rate coming out 1 hour before open. Just last week, U.S. job openings and layoffs were at 2009 recession levels. And again, this data is going to be coming out Wednesday before open. So it's going to be very big data. This could move the market in a major way. At the same time, on Friday, we are going to be having CPI data release as well. Inflation data is set to come out 1 hour before open on Friday. So 2 huge days this week as far as data is concerned.
And we have a lot going on geopolitically as well. The nuclear talks between the U.S. and Iran remain in a state of a max uncertainty, and betting markets agree. We can see that there's a 47% chance that the U.S. strikes a nuclear deal with Iran before 2027, but there's also a 51% chance of the U.S. actually striking Iran by June 30th. So this is peak uncertainty here. The White House also just urged U.S. citizens to leave the country and signed a new executive order allowing the U.S. to impose additional 25% tariffs on any country doing business with Iran.
And at the same time, there's even 112 U.S. Air Force aircraft that have arrived in the Middle East over this past weekend between February 5th and February 7th. That is a huge amount of aircraft. Again, this is a time of peak uncertainty right now regarding the Iran situation and the geopolitical news. If something pops off, it could end up moving markets. So keep this on your radar this week. It will be extremely important. But another thing to keep on the radar, Mike, is the insane earnings that are going on. Now, we're not going to see as many Mag 7 players report this week, but I got to say, there are some fun reports coming out. Whether you're looking at Datadog, Spotify, even Coca-Cola has been popping off in the short term. Robinhood on Tuesday, Coinbase on Thursday, Moderna Friday. There's no shortage of big movers here.
Love to see it. And jumping into some setups and predictions, a stock that's specifically on my radar this week is ticker symbol MSTR. Strategy has been hit very hard, especially over the past couple of years, and as Bitcoin has dropped lower. We can see on Friday alone, it popped up by 26% as crypto recovered. This is on my radar because we saw a big shift in market sentiment on Friday, where Jensen basically eased fears of the AI capex spending and the AI bubble and everything like that, and definitely got the buying pressure back up again. And this extended into everything, whether it's tech stocks, crypto, or basically anything else. So if we continue to see this narrative develop, I would not be surprised to see crypto recovery and also MSTR. Of course, crypto is volatile, as is MSTR, but I think it offers a good risk reward if a tight stop loss is used, where, like we've seen in the past with MSTR recoveries, it can have 100 point plus swings. Again, it's on my radar, but I want to see continuous pressure on recent highs.
We're still in the same range since October of 2025. Now, the market is as dislocated as ever, while the indices haven't really moved in weeks. So many stocks, and mega cap stocks at that, are in corrections or even bear markets. So Microsoft is down 29% from highs. Netflix is down almost 40% from highs. Meta is still down 17% from highs. Amazon is almost down 20% from highs. You get the picture. And the VIX is still trading at 18. So no doubt we are in a volatile market, although it looks like the indices are just compressing here or consolidating. That begs the question, was Friday's bounce just a relief bounce, i.e. a bull trap or dead cat bounce, or was it the local bottom before going higher? So I will try and answer that question for you right now based on all of the data that we have and tell you what is upcoming in the market, what I'm looking at, what I'm looking for this week and beyond, and how I'm positioning here. Let's get right into it. So when we're in ranges here, there really is no need on a day-by-day basis to be like, oh my God, we're red. Oh my God, we're green. Oh my God, we're red. Guys, we have not moved since October. Now, as I said, the market is disconnected. The S&P equal weight has made an all-time high once again. The Dow Jones has made an all-time high once again. And these rallies were largely driven by non-tech stocks and non-Mag 7 stocks. Consumer staples are at an all-time high, and that is largely what is keeping the indices afloat. But it's also what's keeping the indices stagnant, because if you look at the weight of the 7 largest stocks in the S&P 500, this is the most concentrated stock market of all time. So if the Mag 7 are not rallying, then that means that if the rest of the stocks are rallying, the market is just going to stay at this flat level. Now, from a technical perspective, the S&P 500 just bounced off of the 100-day moving average. This is very typical price action. And I would not be surprised if in the short term, we made a new all-time high on the S&P 500 above 7,000. We've already hit that 7,000 level before. And this is why I'm still not short the market. As I told you last time, I am proceeding with caution here. And I think that there is a lot of reason to be cautious. There's a lot of reason to be very selective about the stocks that you choose to enter here. You want to really deliberately try to find value here and not just throw your money at everything, because again, we are in a dislocated market and stocks in different sectors are just moving completely divergent. When we have this type of dislocation, as you can see here, NASDAQ fell 1.4%, but more NASDAQ stocks went up than down. This tends to create a lot of volatility, which is part of the reason why I said we want to proceed with caution here. But from a structural perspective, I am not ready to short the market yet. Nothing looks broken here. I told you guys on the weekly, if we get a major close below this trend here on the weekly, then I will start to think about actively shorting the market and protecting myself. Right now, in my tax advantage accounts, I just started trimming and raising cash. And even though on the daily, QQQ looks like it could potentially reject from a revisit of this 100-day and move back down to the 200-day, the weekly has not done anything structurally damaging yet. There is also a saying that never short a dull market. And right now, the market is no doubt dull. According to Ryan Dietrich, shout out to him, the S&P 500 has gone 4 weeks in a row with weekly gains in between 0.5 and negative 0.5%. That is an incredibly tight range. And that's why you can't overreact to every single day, whether it's green or red. We have not gone anywhere simply. Now, this hasn't happened since 1965. If we take a look at 1965 on the S&P 500, we're talking about this period here. And this came at the end of 1965, where we were trading in a very tight range and then ended up in a bear market in 66. Now, one thing that undoubtedly can happen, because we are still in the AI bubble phase, we are still in a bull market and nothing has broken down yet. One thing that can happen is all the stocks that were beaten up. So if you just look at the tech sector, for instance, almost hit the 200-day moving average. This is XLK. The tech sector can then catch up to the rest of the consumer staple stocks and the rest of the categories in the S&P 500 and the Dow Jones. And for sure, tech can now stage a potential rally and we can get a blow off top, especially because 31% of NASDAQ stocks are now oversold. And although that still presents a ton of volatility in the short term, in the midterm, as we know, when you get to extremely oversold levels on certain categories of stocks or on the market at large, you will get a bounce a few months later. But in the short term, it could lead to extreme volatility. And you mix in the fact that the put call volume volume is above 1, and we know when the put call volume is above 1, that typically tends to at least produce a few short squeezes, if not a local bottom. Now, I was doing a little bit of research on midterm years because we are in a midterm election year. And like I said, I do expect to see a correction this year, but I also expect the year to end green. However, I might modify the timing of my projection that I shared with you guys on the S&P 500, where I said I expect a major slowdown in the beginning of the year, and then after the correction bottoms out, end the year green, not red. However, when I looked back at all of the midterm years, this seems to be pushed out further than in regular years. So in midterm years, we tend to see the corrections happen later in the year rather than earlier in the year. And this would support the case for a potential bounce, making a new high in the short term, and then seeing a correction in the March-April timeframe. I'm not Nostradamus. My only job is to see what the probabilities are based on the information that I have and try to make the most informed decision, not based on emotion. So right now, I am not going to short the market here. I don't see that being a high probability trade, especially with the indices recovering back into the ranges, at least on the S&P 500. NASDAQ still looks a little precarious, but there is little reason, in my opinion, to take a short here, at least an optimal short. Now, there are some stocks which I think will see more weakness, Tesla being one of them. And I did start putting together a list of stocks that I want to pick up. Like I said, I think this is going to be a stock picker's market this year with so many dislocations. So I already started picking up Microsoft. I told you guys about Broadcom. This had a monster 7% day on Friday. Could be a relief rally. Either way, I thought Broadcom was undervalued. Obviously, stocks like Google, I haven't sold out of and don't plan to. My non-tech stocks are doing fabulous right now. Pepsi, Costco. And some of you guys were laughing at me about NVO because I said that NVO was a buy in the low 50s. But I do think this right here is panic. And I do think that with HIMS not being able to sell their knockoff Wegovy, I think that'll bode well for NVO, and NVO will recover. I gave you guys my dollar cost average levels on Hood. This is a stock that I picked up. If we do get another drop to this previous high, we'll start picking up more here. Netflix, as I said, I think is a good buy here. I don't think momentum is with Netflix, but I think it's a good value here. Now, call me crazy, but I do think AMD can be a potential short. I just cannot short it from here. I needed to get back into this gap. But AMD still hasn't closed the OpenAI gap. It is the only stock that's associated with OpenAI that has not retraced back down to levels where there was some sort of OpenAI announcement. So Microsoft, NVIDIA, CoreWeave. Now, one sector that is really interesting me is IGV. This is the tech software sector. And this has been the most beat up sector in the market, I think. So if you look at this is down now 31%, was almost down 35% from highs. But I was taking a look at the weekly chart, and on the weekly chart, you could see that this is holding the trend line since 2008. And we are oversold on the RSI as well. And if I pull up the 200-week EMA, you can see that we are sitting on the 200-week EMA. Now, some of the stocks in this ETF are Microsoft, Palantir, Salesforce, Oracle, Intuit, Adobe, Palo Alto Networks, AppLovin, CrowdStrike, ServiceNow. But if you take a look at the software stocks, I mean, individually, they are just bleeding. Now, I think some of these are going to be repriced permanently because of what the advancement in AI means for these stocks' futures. But I do think that software stocks will see a violent bounce. And some of these stocks are going to be winners. You can hear some of the thought leaders like Jensen Huang saying that a lot of these software stocks like Salesforce, for instance, or Microsoft, AI is not going to replace them with a suboptimal version, a vibe-coded suboptimal version of these stocks. But AI will likely be a really strong companion for these stocks. So a company is not going to replace Salesforce with a inferior product that was vibe coded on Claude, but it can use Claude to enhance Salesforce's capabilities. However, I don't think that this bleeds forever, and I do think software stocks will eventually see a violent bounce. I just need to see how this week goes in the market. And again, here's another chart talking about how dislocated the market is. Many stocks are pushing to new highs, other stocks are pushing to new lows. This type of dislocation was reminiscent of what happened in 2000. And I don't really pay attention to Hindenburg omens, but we had 3 in 1 month. The last time this triggered was Liberation Day of last year, the 2022 bear market, the 2020 COVID crash, and the 2018 stock market correction, which almost was a bear market. So once again, with so many conflicting signals, with a dislocated market, with a market that has gone nowhere, I'm very cautious here, not to be overly bearish. I'm not shorting the market yet. I am raising cash in my tax advantaged accounts. In my non-tax advantaged accounts, I do plan on hedging, but this is not the time, as I said. And in terms of what's going on next week, we have retail sales data, we have non-farm employment change data, we have unemployment claims, and then we have CPI on Friday. Now, the employment data is looking interesting to say the least, with layoffs climbing to levels that we haven't seen since 2009. So I'll be very curious to see what the unemployment rate and unemployment claims look like. And the expected move for the S&P 500 for this week is 120 points. Now, how big of a range is that? Is that volatile? If we take a look at this, 120 points is really just back to Friday's opening, if we're talking about the low end. And on the upper end, 120 points does mean a new all-time high to around 7,051.